Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today on this live stream. We're doing this at noon Eastern time as opposed to the 9 o'clock normal time we post. But thank you everyone for joining us today. And with us today is Craig Hemke, our good friend from TF Metals Report. Craig, thank you so much for joining us today.
Oh, it's always a pleasure, Elijah. Nice to see you.
Well, it's great to have you on today. I did want to discuss kind of what we're seeing, obviously, over the weekend. Biden signed the debt ceiling suspension. I'm a bit confused what that all means. It's not really a raising of the debt limit, it sounds like. But your perspective on this, it seems like the government has, said we're just going to continue to spend to oblivion here.
Well, they pulled this trick before, back after the great financial crisis. They went from a hard number cap to the debt. I mean, hold on. This is all theater anyway. I mean, everybody knows. I mean, the whole thing about, are they going to get it all figured out before the U.S. defaults? I mean, they're all just trying to score political points ahead of the election next year. So let's make sure we all are on the same page there. There was never going to be any default or any whatever. All right. So anyway, they've done this little trick before, though, where they changed the ceiling to a date certain instead of a hard number. They did that after the financial crisis, and then they flipped it back. And now here we are again. Why? Well, again, in the political circus of all this, everybody at some point had to bump into a news headline or a story about the debt ceiling. Oh, what's going to happen, right? And it was all talked about really the last couple of months. Okay, so they go through all these negotiations, and now they announce that, okay, we've raised the debt ceiling. Okay, well, Elijah, what if they raised it $1 trillion? Okay, it's a mind-blowing amount of money, right? You just how many dollar bills you stack to the moon and all that. $1 trillion. So let's say that's what they do. We go from whatever, 32 trillion to 33 trillion. And then they go through that trillion like crap through a goose. And it's like, I don't know, December, maybe next January, and all of a sudden the debt ceiling's in the news again. And I mean, even the most sleeping sheeple would go, wait a second, hold on here. We just went through this. And you said it was another trillion, and you've already blown through the trillion? Well, what's going on here? They certainly can't have that in election year next year. So what do? This is the most cynical thing they could possibly do. They change it to a date beyond which their borrowing authority ends. Oh, and when's that date? 2 months after the election, January of 2025. So they get all their political points. They get an open-ended credit, whatever, to add on 3 or 4 trillion now. And then they'll have this debt authority, spending authority till January 1st, 2025. And lo and behold, during the lame duck session of Congress in December of 2024, they'll pass an extension. And that's how the scam works. It's cynical political garbage is what it is.
The interesting thing, in some way, this is nothing new, right? This is what we see countries throughout history when they move to a paper currency system. This is what happens, right? Your whole website, TF Metals Report, one of the mottos you have, or whatever maybe correct me of exactly what you call it. You say, we're watching the end of the Keynesian experiment. Can you expand on how this debt situation, where we're just going as much debt as we can possibly get, and we're seeing exponential increase in the debt, how does that play into this Keynesian experiment, as you call it?
Well, John Maynard Keynes was the economist who came up with this idea 90 years ago, this debt-based monetary system. And I guess, as long as the numbers are small and you can manage the debt, I guess it works. I mean, here we are talking about it as proof that it got us this far. But at some point, the amount of accumulated debt is so large that you can't continue to service it just by extending more and more debt, printing more and more cash, inflating the money supply. And you get into these economic contractions, which are inevitable, that lead to deflation. And eventually, the whole thing begins to teeter and totter and collapse. And that's what we've been waiting for. Now, look, I thought coming out of the great financial crisis, when I started this website, I didn't know if we'd make it to 2011, much less 2023. So I don't know what the magic number is. I'm not sure, is it $35 trillion? Is it a percentage of GDP? Is it that the cost, a line item to service that debt every year is so great that it soaks up all of the tax revenues, that the government brings in? There's no money for anything else. We'll see. I mean, it's coming. I don't think there's any doubt about it. I just don't know what the ultimate trigger is. To the idea, though, about do you get to that point where you don't have enough government funds through tax revenue, because that's the only way they bring money in, right? The government through taxes and fees. That's their income, if you will. When you get to that point where that servicing the accumulated debt becomes such a large slice of the pie that you can't do anything else, or you just have to simply just start monetizing everything. We're getting close. I saw a thing last week of the about $32 trillion of existing, whatever you want to call it, publicly held debt, about 24 trillion matures and is going to have to roll over in the next 3 years. Now, why is that? Well, remember all this period of zero interest rates and 1% interest rates. How is it that we're not at that point yet where the line item is of interest on the national debt is so high? Well, because the Treasury Department has shoved so much of that debt into the shortest end, the short end of the yield curve where the yields are lowest. You'd have thought, hey, you know what? While the 30-year long bond is at 2%, maybe we ought to put it all in there. No, they didn't do that. The average maturity, something like 3 years, maybe 4. So a lot of that stuff's coming due now. 3/4 of it, $24 trillion is coming due over the next 3 years. Fed has played these games over the last 15, 18 months of spiking interest rates and has driven the 2-year note up to 4.5 and the 10-year note up to 4. How can rates stay here as the government has to what they call refund as those bonds and notes and bills mature and then reissue them at this higher rate? We're already about $700 to $800 billion a year in interest on that accumulated debt. What if all of a sudden, $30 trillion is at 4%? That's $1.2 trillion a year just to service that. And what's the military budget? $700 billion, that sort of thing. And what do you get? A bad economic period where tax revenues drop. So we're getting to that point where, sorry, this is a long answer, Elijah, where this is ultimately headed. And again, this is from the guy that, didn't know if we'd make it the last 12 years. So who knows how long it's going to take to get there. Where this ultimately headed is kind of a Japan thing where the Fed will institute yield curve control. And they'll just simply say, we're not going to, we'll bid for every treasury that, equates to a yield over 2%, that sort of thing. And they'll just monetize all the existing and future debt at a certain level. And we're just going to have to deal with the consequences.
Now, this viewer is asking about Japan, actually. So they ask, why can't this go on indefinitely? Isn't that what is happening with Japan? They haven't collapsed yet. So why can't we just, as you mentioned, what would be the consequences of just doing what Japan is doing?
Well, I mean, it's not a direct apples to apples comparison. A number of things about Japan's demographics and their fertility rates about 1.1, and the average, the age of the population is getting really, really high. And so they've been fighting deflation for 30 years. I remember when I got out of college, everybody said the Nikkei, in the late 80s was this huge thing. And it's just now getting back to the levels it was 30 years ago. So they've been able to monetize and run yield curve control and all that stuff because the deflationary impulse is so great in Japan. Think of it as kind of just evening itself out, just kind of doing a little of this stuff. That's why I said I don't think you can compare the US to Japan because, again, the demographics are different. The role of the US dollar versus the role of the Japanese yen on the global stage is different. There are a number of different things that makes it different. I think where we're eventually headed is so much direct debt monetization that it outweighs the deflationary impulse. And this inflation that we have now is not only entrenched, it gets worse. And if you think about it, again, from a monetary standpoint, that's kind of the Keynesian bargain. You want to continue, you want negative real interest rates so that you are continually paying off yesterday's debt with the cheaper monetary base of tomorrow. That's how you service it. That's how we got out of this before in the night after the World War II. So that's where this is all headed eventually. And it's a pretty gnarly picture for the regular people. If you in that, that elusive 1% or even 10%, okay, you can probably maybe navigate your way through it. But for the regular people that are working 3 jobs and trying to put their kids through school and, I'm sure you've seen the stats, Elijah, and whatever it is, 65% of working adults don't even have $500 in the bank, if their car breaks down. Those are the people that are really, really, really going to be feeling it in the years to come. And then we'll see, what does that do for the social fabric of this country and around the world? Again, big picture stuff, but to a short question about Japan, it's a different deal.
It is a different situation. And you mentioned how very soon you're going to see a lot of this debt roll over to higher interest rates.
Mm-hmm.
Trevor is wanting to know, when the rollover date hits, won't the Fed drop the rates before this, like everyone is expecting?
That's just it. I mean, I've said this forever for these reasons, that they cannot afford to raise interest rates. And then, in these periods when rates go up a little bit, like 16 or an 18, or even this year, people say, oh, you're an idiot. Look at rates are going up. You're taking that out of context. They cannot afford to raise interest rates. Oh, sure, they can fight the fight for 6 months and play their rhetorical games and try to talk the market into doing some of the heavy lifting for them. But this idea that they've put out now, well, in 2010 and again in 2015 and again in 2018 and again now this year and last, that there were normalize interest rates and normalize the balance sheet. Yeah, dude, come on. That ain't going to happen. They can't. They absolutely cannot do that. And so, I think you said it was Trevor. Trevor's right. They will attempt to cut rates and and again, we're just going to have to deal with all of those consequences of the higher inflation and the sharply negative real interest rates, where, the bank, well, not the bank, the bond or whatever you have is paying you 2 or 3%, but inflation is 5 or 6. And so you're actually losing 3% of purchasing power every year. That is a negative 3% real interest rate. Historically, that is very good for gold prices. People think gold tracks inflation. It doesn't track inflation. That's just half the picture. Gold tracks real interest rates. That's the thing to follow. And that's the period that we're heading into again.
Now, we've been talking a lot about what the Fed is going to be doing, what the government is doing with respect to the debt, and how that is going to impact things. We have also seen some economic data come out, the jobs report last Friday, and some more economic data coming soon. Some of it can be a bit confusing, as you've mentioned on your website. A lot of people are saying that, high interest rates are going to put a strain on the economy. We're going into recession. Can you kind of unpack what the BLS reported and how we maybe should be interpreting this?
Well, let me start by talking about the impact on gold, because I've been warning since I wrote my forecast for this year back in the first week of January. There were going to be these kind of fake outs. We're going to get wrong footage. You're going to think gold's going to break out. We're going to get above 2,100. We're going to go to 2,300. That's going to happen, but it's not going to happen until everybody's finally on the same page that the Fed is done and the next move is to cut. Because in between, you get a period like current period, or like what we saw in February, where suddenly the data appears to be stronger. Oh, higher for longer, Elijah, and rate hike expectations. We went from when Powell got done speaking after the May FOMC 5 weeks ago, there was a 0% chance of a rate hike in June, 0. And it stayed there for a while. Then, some of the Fed goons go out there and start talking, and you get a couple of ticks in economic data, it's 0.1% of 1% better than expected or something. All of a sudden, there's a 50% chance of a rate hike in June. So until we get to this area where there's not only everybody understands there's a 0% chance of a rate hike, but that Fed funds futures market starts playing out where, we're actually anticipating a cut now in September, and maybe another cut by November and one more in December. And we start on that, we're over the cliff and heading back down. That's when gold breaks out. Okay, so that's the first thing. So in the meantime, you're subject to these data points. Like we're recording this today. So you got the jobs report last Friday. Oh man. And now all of a sudden there's rate hike expectation again. And down goes gold. Today, the service sector purchasing manager indices, PMIs, come out. And all of a sudden they're falling into contraction, very close at least. Gold goes back up. Rate hike expectations go down. So we're going to continue to play this game until we get into this recognizable thing that now we're over that edge and headed back down. Regarding the jobs report, look, I've followed this for as long as there's been a TF Metals report, 12 years, 13 years. We call it it comes from the Bureau of Labor Statistics, the BLS. We call it the BLS BS. And it's been that way for years. It is statistical gobbledygook. You got it on the 2nd of June. And you're told that this is an accurate representation of how many jobs were created in May. Well, wait a second. Didn't May just end? Right. So what is it? It's all just statistical guesswork. Oh, there's a little surveying. They make a few phone calls in the middle week of the month, but you can't possibly know. And they know they can't possibly know. So there are seasonal adjustments. There's something called the birth-death adjustment, where they look at the average of the last 20 Mays. And they go, well, on average, we know that there are X number of businesses that open and X number of businesses that fail on average over the last 20 years. The net result of that is X number of jobs on average the last 20 years. And so we're going to figure that that's what happened this month too. As if May 2023 has anything to do with, May of 2013 or something. Okay, but it's all guesswork. You get into some of the numbers then, and you also see the phony baloney thing, like the establishment survey, where you call up a business and they say, oh yeah, we're hiring all kinds of people part-time. And then gets printed a big number. And then the household survey, where they call people up and they say, yeah, I lost my job over the last month. The household survey was a loss of like 300,000 jobs. So who are you going to believe? In the end, the number that gets printed and shouted is that headline number. It is the 14th consecutive month, Elijah, that it exceeded expectations. 14 months in a row. Now, that sounds unusual, doesn't it? Could it possibly be some political motivation? Maybe. We know 90% of government employees are registered Democrats, and the president's a Democrat. I don't know. All I know is 14 consecutive months, when the previous streak was 3, 14 consecutive months kind of seems a little suspicious to me. So we'll see. They can play their games. They print the number. The computers that do almost all of the trading read the number and then react, and they sell bonds and they buy the dollar. And then the other computers see the bonds going, rates going up and the dollar going up, and they sell their gold, and it's whatever. You can put it off for as long as you want, but there's a certain reality. You can gloss it over, you can try to spin it, but there's a reality of what's going on here. And the piper will get paid here soon enough.
Now, Trevor actually asks a very insightful question here regarding the coming volatility in the metals that we're already seeing, right? And you mentioned how, the first half of the year, we're going to see a lot of volatility, not too much like explosive moves to the upside. He asks, Craig, should I hold my paper silver through the volatility or sell in hopes of getting it cheaper? When it comes to trading, obviously, you can do whatever you want. I think one of the things with holding physical metal, though, is it prevents you from being shaken out or making any, rash decisions on selling it right away. But your perspective on that, for those who are maybe trading the market, would it be better maybe to sell now and buy again later?
I stopped trading a long time ago, and people say, well, you're so smart. Why aren't you trading? You know why? Because I'm feeble-minded. I get emotional about my trades. And then it impacts how I'm supposed to be just objective watching this stuff. If I've got a trade on, I just who I am. I root for it. Most people do. And then it impacts how I see the world. So I very rarely trade. If I were to trade, if I were to put something on, it would be once we get past that obvious inflection point. You think gosh, I can make a lot of money. If I call the breakout right, yeah, you can actually make a lot of money after it breaks out too. In the meantime, you're just as apt to get wrong-footed. There's an old adage in the precious metals, at least at my site, that I think still holds true almost all the time, is that if you're trading, when things look the rosiest, like when Powell got done speaking 5 weeks ago, and gold opened that night at 2080 or something, and then Pac West was going to be the next bank to fail, and all this stuff. When things look the rosiest, you've always got to be ready to sell some. It just works that way. And when things look the best, so when things look the worst, look, we're banging around here at 1625, and price is going to drop out, fall out of bed, or 1840 back in February, and sentiment's in the toilet, and we're back to even on the year. That's when you got to buy some. So anyway, to Trevor's point, for the precious metals, man, I just, if paper silver, meaning it got an ETF or something like that, I wouldn't really jack around with it at all until price was above 28 and setting its sights on 35 or 6. In the meantime, you're probably more apt to be wrong than you are to be right, and you're just going to frustrate yourself.
I think it's a very good point there. And for those who don't want to be trading in and out of the metals, like I mentioned, holding physical metal, I think, is a great way to do that. And it really just, it gets back to what I've heard Rick Rule say multiple times, that if you shouldn't be concerned about pullbacks if you still believe in the original thesis or reason why you invested your money in that product in the first place, right? Or in that stock. It's like if prices go down, you should be happy because you can buy more. If you truly believe that that's a good place to put your funds.
And I'll extend that one further. A lot of talk last week about how poor sentiment was. I got asked about it in a couple different interviews, and I'm like, well, to your point, Elijah, it's like, well, wait a second, gold's up, 10% year to date. Heck, if you take out the 6 Fridays of the jobs report, $91 in 6 days. If you add up the losses on the 6 job report Friday so far year to date, that's $91 in losses, but yet gold's still up $130. Okay. So gold's doing what it's supposed to. It's up 10% year to date, but everybody's, suicidal and, just so depressed and distraught. Well, those are mainly the mining share people, that bought mining shares as like a call option leverage to price. And that can be fine if price is going up, but all those mining companies have specific issues, whether they're exploring for metal or whether they're actually pulling it out of the ground. And it can be very, very frustrating. And so people are depressed because the shares aren't going anywhere. Well, okay, well, that's just you because you're trying to make some cash. It's pretty hard. You got to separate the two. And your physical precious metal is doing, in large part what it's supposed to do. I own physical gold for a number of reasons. We talk about that's what my site's about, is stacking physical metal, not trading mining shares, though we discuss that stuff. And why? Because I think gold is vastly undervalued, given how the price is determined through all these futures contracts and forward contracts and paper trading in London and all that kind of stuff. I think it's vastly undervalued. I think there's far less gold than what the world thinks. And if that's the case, then holy cow, is silver undervalued. If gold finds its true price somewhere, twice what it is now, let's say it's $4,000. I'm just picking a number out of my rear end, $4,000. Well, what's the right price for silver on a gold silver ratio? Even if it's 80-1, it's $50 silver. I think I did that right. So anyway, I think there is a fundamental value proposition in owning physical metal. And that's why I still prefer it to everything else.
Fantastic. Well, Craig, we really appreciate your time today. If our viewers are interested in learning more, we have the link to your website in the description of this video, and it's obviously right there as well, tfmetalsreport.com. Tell us a bit about that.
Look, I'm bragging, obviously, but I don't think there's any place else like it, especially for precious metals investors, not for what I do, but just for the community of people. I mean, I could probably stop doing what I do, and there people would still be showing up just to read what all the contributor, all the posters, all the people that comment what they put on there. It's look, if you're looking for I don't know, a harbor in the tempest, that's what TF Metals Report is. The people that we're all just trying to get ourselves through the end of this great Keynesian experiment, come out the other side. So at a time like this, man, I think as much independent, objective information is just vital. $15 a month, a whole whopping 50 cents a day to check us out. So please, I mean, give it a try. Join us for a month. See what you think.
Any last thoughts before we let you go, Craig?
Well, we're going to wait for the Fed next week. We'll see. If they pause and they don't do anything, people are going to say, well, they're maybe by July. I think the calendar you're going to want to watch going forward is that the typical average amount of time between the last Fed hike and the first Fed rate cut, about 75 to 90 days historically. So if they're done, then I think what we got to start targeting is Powell's Jackson Hole speech, which is always a big thing every year at the end of August, kind of setting the table as to where they're going to go from here, and then anticipation of a first rate cut in September. So be patient, hang in there through next week and through July, maybe, sell in June and try not to swoon, something like that. And then let's just see what happens when we get in that kind of seasonally strong August, September period. And then would not surprise me if we don't get a breakout and we finish the year in all-time high territory for gold.
Fantastic, Craig. We always appreciate your time, and thank you so much for joining us on this live stream today. And God bless.
Thank you, Elijah. It's always good to see you.